There's a chart that every serious gold investor has seen at least once, and it is quietly terrifying. It shows an ordinary family in the late 1970s who put their life savings into gold at exactly the wrong moment. They watched their investment lose more than half its value over the following 2 decades, even while the newspapers kept insisting gold was the safest asset on earth. That family was not careless. They were not uninformed. They simply could not tell the difference between a real opportunity and a trap dressed up to look like one. Today, that same setup is playing out again in real time, and most people watching it happen have no idea which side of history they are about to land on. Gold and silver are back in the national conversation, and this time it feels different. Prices are climbing, financial news anchors are using words like historic and unprecedented, and everyday Americans who have never owned a single ounce of precious metal are suddenly asking whether they are missing out. That kind of moment is exactly when the most money gets made, and it is exactly when the most money gets lost. The two outcomes look identical in the early stages. The only way to tell them apart is to understand what is actually driving this market, not what the headlines are telling you to feel about it. Over the next 20 minutes, we're going to walk through this carefully and honestly. We will look at how these traps have formed before, what forces are genuinely different about today's market, what could unravel this rally faster than most people expect, and how you can think about your own decisions without letting fear or excitement make the call for you. This is not a sales pitch for gold and silver, and it is not a warning to stay away from them either. It is a clear-eyed look at both sides, so that whatever you decide it with your eyes open. To understand where we are today, you first need to understand how a precious metals trap actually forms, because it almost never looks like a trap while it's happening. It looks like an opportunity. It typically starts with a legitimate reason for concern. Maybe inflation is rising, maybe a war breaks out, maybe a major bank collapses. Whatever the trigger, it creates real fear, and that fear sends a first wave of cautious, informed buyers into gold and silver as a form of protection. Prices begin to rise, and for a while, that rise is fully justified by the underlying situation. Then something shifts. The story stops being about the original economic concern and starts being about the price movement itself. Financial media notices the rally and begins covering it constantly. Social media accounts start posting screenshots of gains. Friends and coworkers start mentioning it in casual conversation. At this stage, a second, much larger wave of buyers enters the market. But this wave is not buying because of a careful read on debt levels or central bank policy. They are buying because the price is going up and they don't want to be left behind. This second wave is what actually creates the trap. It pushes prices well beyond what the original fundamentals support, and because that excess buying is emotional rather than analytical, it is fragile. It takes very little to reverse it. A single piece of unexpected economic data, a shift in Federal Reserve language, or simply the natural exhaustion of new buyers can be enough to turn the rally into a rapid decline, catching the last wave of buyers at the worst possible price. This pattern is not unique to gold and silver. It shows up in nearly every asset class throughout history. But precious metals are particularly prone to it because they are so closely tied to fear, and fear spreads faster than careful analysis ever will. Once you can see this pattern clearly, the next question becomes obvious. Where exactly are we in that cycle right now? To answer that, we need to look at the specific forces currently at work. Let's go back to the story from our opening, because it holds real lessons for today. Throughout the 1970s, the United States experienced a rare and painful combination of high inflation and weak economic growth known as stagflation. Gold, which had only recently been allowed to trade freely after the U.S. abandoned the gold standard, became the go-to hedge against a currency that was visibly losing purchasing power year after year. By January 1980, gold had climbed to roughly $850 an ounce, an almost unimaginable price at the time. The buying frenzy was intense. Investors who had watched inflation eat away at their savings for a decade finally felt like they had found the answer. But that final surge was driven overwhelmingly by panic buying rather than a calm assessment of value. Within just a few years, aggressive interest rate hikes from the Federal Reserve under Chairman Paul Volcker successfully brought inflation under control, and gold entered a brutal multi-decade decline. It would not reclaim that 1980 high in nominal terms until 2008, nearly 3 decades later. Here's the important lesson buried in that story. The underlying concern in the 1970s, out-of-control inflation, was completely real. Gold's role as a hedge against that inflation was completely legitimate. And yet, investors who bought at the emotional peak of that story still lost decades of purchasing power, because the price had already run far ahead of what even a real crisis could justify. Being right about the problem does not automatically mean you bought at the right time. That distinction between being right about the story and being right about the timing is the single most important idea in this entire video. And we are going to keep coming back to it as we look at what's happening today. Now let's look honestly at the forces currently supporting gold and silver because dismissing this rally as pure repetition of the past would be its own kind of mistake. The clearest difference is the behavior of central banks themselves. Over the past several years, central banks across multiple continents have been adding gold to their reserves at levels not seen in decades. This is a documented, measurable trend, and it matters, because central banks are not day traders chasing a headline. They are making long-horizon decisions about how to store national wealth outside of any single currency, including the US dollar. When the buyers driving a market are institutions with multi-decade time horizons, rather than retail investors reacting to a chart, the character of that buying tends to be far more stable. The second major difference is the scale of government debt relative to the size of the economy. The United States is carrying a debt burden that, as a share of economic output, exceeds levels seen during the 1970s stagflation era. High debt levels create a structural incentive for policymakers to tolerate somewhat higher inflation over time, because inflation effectively reduces the real value of existing debt. Investors who understand this dynamic often view gold as protection against that slow structural erosion, not just against sudden price shocks. This is analysis based on well-documented economic relationships, not a certainty about future outcomes. The third difference is the diversification of who is buying. Unlike the 1970s, when gold buying was concentrated among a relatively narrow group of investors, today's market includes central banks, large institutional funds, and everyday retail investors accessing precious metals through modern platforms that simply did not exist decades ago. A broader, more diverse buyer base can create more sustained demand, though it can also introduce more volatility if retail sentiment shifts quickly. Taken together, these three forces build a genuinely different foundation than what existed in 1980. That does not mean prices cannot fall. It means the reasons behind the current strength deserve to be taken seriously, rather than dismissed as simple repetition of history. With that said, there are real cracks in this story that deserve just as much attention as the bullish case, and ignoring them would leave you dangerously exposed. The first crack is the sheer speed of recent price appreciation. Markets that move too far, too fast, tend to attract exactly the kind of late, emotional buying we described earlier, the kind that has historically preceded sharp corrections. Fast moves are not automatically fake, but they are statistically more fragile than slow, grinding trends, because they rely on a constant stream of new buyers to sustain themselves. The second crack is Federal Reserve policy uncertainty. Gold and silver tend to perform best when interest rates are falling, because metals that generate no yield become relatively more attractive when the return on safer assets like bonds declines. If inflation data comes in hotter than expected, or if the Federal Reserve signals a more cautious approach to future rate cuts than markets currently anticipate, that could remove a key pillar currently supporting metals prices. This remains uncertain and depends on economic data that has not yet been released, so it should be treated as a risk to monitor, not a forecast to rely on. The third crack is the role of leveraged trading. A large portion of daily gold and silver trading volume flows through futures markets, where investors can control large positions with a relatively small amount of actual capital. Leverage magnifies gains, but it magnifies losses just as sharply, and it tends to accelerate declines once they begin because leverage traders are often forced to sell quickly to meet margin requirements. This dynamic has historically turned ordinary pullbacks into sharp, fast corrections. The fourth crack, and perhaps the most underappreciated one, is investor psychology itself. The more mainstream and widely discussed a rally becomes, the smaller the remaining pool of new buyers tends to be, simply because attention and capital are finite. Extreme optimism, even when built on legitimate underlying reasons, has historically marked periods where upside becomes harder to sustain, not easier. None of these cracks guarantee a collapse, but together, they explain why experienced investors treat rapid rallies with respect and caution, even when they believe in the long-term story behind them. So how do you actually navigate this without becoming either the person who missed a historic opportunity out of fear, or the person who bought at the top out of excitement? Start by separating the pace of the move from the direction of the move. A market that grinds higher steadily over many months with regular pullbacks along the way is behaving very differently than one that spikes vertically in a matter of weeks. The first pattern reflects gradual accumulation. The second often reflects short-term emotional buying that is more vulnerable to a sharp reversal. Next, focus on who is actually buying. Sustained central bank accumulation and steady institutional demand tell a different story than a sudden spike in retail trading volume or surge of new attention on social media. The former tends to be more durable. The latter tends to be more reactive to headlines and more prone to unwinding quickly. Pay close attention to actual Federal Reserve decisions and economic data releases, rather than speculative commentary about what the Fed might do. Official policy actions move these markets far more reliably than predictions and opinions, no matter how confident those predictions sound. Finally, think seriously about position sizing and timing. Rather than committing a large amount of capital at a single moment, particularly during a period of rapid price appreciation, spreading purchases out over time can reduce the risk of buying entirely at a short-term peak. This is a general principle of disciplined investing, not personalized financial advice, and your own circumstances, goals, and risk tolerance should guide any decision you make. These tools will not make you immune to volatility, nothing can, but they give you a way to separate signal from noise in a market that is specifically prone to blurring the two. So what happens from here? Based on the evidence currently available, a few different paths are realistically possible, and it's worth being upfront that these are analytical scenarios, not guarantees. One path is continued, more gradual strength, supported by ongoing central bank buying and persistent structural debt concerns, with normal pullbacks along the way, rather than a sharp collapse. Another path involves a faster, more painful correction, likely triggered by stronger than expected economic data or a shift in Federal Reserve communication, which could shake out short-term buyers before any longer-term trend has a chance to reassert itself. A third path is an extended period of sideways movement as the market digests recent gains and waits for clearer signals from policymakers and economic reports. Nobody can tell you today which of these paths will actually unfold, and any source that claims certainty about the future direction of gold and silver prices is overstating what anyone can actually know. What can be said, based on the evidence in front of us, is that the structural forces behind this rally appear more substantial than in several previous cycles, while the short-term risks remain very real and should not be dismissed simply because the long-term story sounds compelling. Let's bring this back to where we started. That family from the 1970s were not wrong about inflation. They were not wrong that gold could serve as protection against a weakening dollar. Their mistake was letting the excitement of a rising price replace careful judgment about timing and scale. That single distinction between being right about the story and being disciplined about how you act on it has separated successful precious metals investors from disappointed ones throughout every major cycle in modern history. Gold and silver today sit at a genuine crossroads. The structural case is stronger than it has been in decades, built on real central bank behavior and real debt dynamics rather than pure speculation. At the same time, the pace of recent gains and the ever-present risk of shifting Federal Reserve policy mean this market deserves respect, not blind confidence in either direction. The investors who navigate this well will not be the ones who guessed correctly. They will be the ones who stayed disciplined enough to keep telling the difference between opportunity and excitement all the way through. If this helped you think about gold and silver a little more clearly, take a second to hit that like button. It genuinely makes a difference in helping this kind of honest, balanced breakdown reach more people instead of the usual hype. If you haven't subscribed yet, consider sticking around because we'll keep digging into what's really moving these markets beneath the headlines. And I want to hear from you directly in the comments. Do you think this rally has real staying power, or are you watching closely for the cracks we talked about today? Let me know what you think. Thanks for watching, and I'll catch you in the next one.